Good morning, everyone, and thank you for joining the Maryland Chamber Foundation as we bring you this important webinar to discuss the economy and the prospects for recovery. We are joined today by a very special guest, Mr. Tom Barkin, President and CEO of the Federal Reserve Bank of Richmond. Before we hear from Tom, I do need to go over just a few housekeeping items with you. All attendees should be muted for the entire duration of the webinar. And while GoToMeeting offers webcam functionality, our presenter will not be utilizing this feature. However, you are more than welcome to use your webcam, or certainly you could turn it off if you'd prefer. There will be a question and answer portion that will take place once Tom has gone through his update. Please know he really wants to hear from businesses. And so look for the chat box. Our Vice President of Government Affairs, Ashley Duckman, will be monitoring the chat box throughout Tom's conversation, and she will bring those questions to him once he is done. As a reminder, the Maryland Chamber continues to provide resources during this COVID-19 pandemic, and we have a specific page for all businesses to go to. Keep in mind that we are providing information from our partners, including the U.S. Chamber of Commerce and, of course, Governor Hogan's office. On this page, you will find the Maryland Chamber's newly released Safe Workplace Best Practices and Baselines for Reopening Maryland. It's a set of guidelines for employers as they begin to think about reopening in a safe and responsible way. This document can be downloaded. It was just added to our page on Tuesday, so I encourage you to take a look at that. We will also continue to post all of our webinars that are important to Maryland businesses, so keep an eye on that page. All right, I had the distinct pleasure today of introducing you to Tom Barkin. He is the President and Chief Executive Officer of the Federal Reserve Bank of Richmond. In this role, he is responsible for monetary policy, bank supervision, payment services, and the Fed's national IT organization. He also serves on the Fed's chief monetary policy body, known as the Federal Open Market Committee. Tom is on the ground continually in the Fed's 5th district, which covers North and South Carolina, Virginia, DC, West Virginia, and Maryland, and has brought real focus to the less prosperous parts of that district. Tom joined the Richmond Fed in January 2018. Before that time, he was a senior partner and chief financial officer at McKinsey & Company, a worldwide management consulting firm. He also oversaw McKinsey's offices in the southern United States. Tom served on the board of directors for the Federal Reserve Bank of Atlanta from 2009 to 2014, and was the board's chairman from 2013 to 2014. He is a member of the Emory University Board of Trustees and the Greater Washington Partnership. Tom is a native of Tampa, Florida, and attended Harvard University, where he earned his undergraduate, MBA, and law degrees. Tom, I know our members are really looking forward to hearing from you. So with that, I will say thank you so much for being here, and I will turn it over to you.
Thanks, Ashley. I hope you can hear me.
Yes, sir.
Okay, great. Well, for those of you on the WebEx, I appreciate the picture here. It looks significantly better than what my hair looks like today, 2 months after being shut in. So I'll just go with that. I appreciate you hosting me here. And if okay with you, I might talk about 3 topics. First, my view on the state of the economy. Second, just a brief summary of some of the efforts being made to improve it. And third, some reflections and thoughts on the possible path forward. These are all my thoughts and not that of the FOMC or the Federal Reserve System. I say that just because it frees me up to be as direct as I want to be. And I'm very much looking forward to any questions and comments at the end. So first, the state of the economy. As you all know, our efforts to control a health crisis through social distancing are having staggering effects on multiple segments of our economy. It, of course, started with a shutdown of large parts of physical retail and restaurants and travel and tourism and arts and entertainment. Remember, the U.S. is largely a service economy, almost 70%, and about 30 million people work in just those sectors alone. But over the last month, the rest of the economy has been hit hard as well. Automotive demand has plunged, airline struggles have affected aerospace, $20 oil is decimating the drilling and exploration sectors. Business closures are damaging landlords. The meat supply chain is threatened. Even hospitals are facing a revenue crunch as they forgo elective surgery. Cash flow and liquidity are topics I talk about constantly. This has come on so fast that the core data that you see in the paper is largely obsolete. On Wednesday, first quarter GDP was reported at negative 4.8%. That's the first drop in over a decade, with consumer spending and business investment each down around 8%. But we know the second quarter is going to be much worse, perhaps down somewhere around 30%, most forecasters estimate. And the global numbers should be every bit as bad. If you want to dimensionalize it a bit, we do get a few numbers weekly. One of them is initial unemployment claims. For the last couple of years, they've averaged in the low 200,000s per month. But in the last 5 weeks alone, 28 million Americans have filed for unemployment. That's 17% of the workforce, and well over 5 million a week. Consumer sentiment has plunged at an unprecedented pace, and some real-time indicators that I look at are shocking. TSA throughput is down about 95% year over year. Hotel revenue is down about 80%. Credit card spending is down in the range of 20 to 30%. And I just hear a lot of emotion from folks in those industries who are suffering so that the health of others won't. So if that's the state of the economy, what are folks trying to do about it? Well, you see work in three lanes to try to bridge us to a post-COVID world. Just as a reminder, the last crisis was a financial crisis, and the Fed was the natural lead there. This is a health crisis, so we can support, but at best are maybe in third behind public health and fiscal. So I'll talk about those two and then talk about what the Fed's been doing. On the health side, this is the most critical, and widespread shutdowns have been an effort to ensure that hospitals have capacity. But states are still very much working on how to land a reopening plan that brings commerce back while limiting the breadth of recurrence absent a treatment or a vaccine. And that's a really critical part of any forecast you might make for where we go going forward. The second piece is fiscal, and a lot of money has been put behind fiscal, but I'd just remind you, it's really about stabilization, not stimulus. This has been a stabilization program. There's been an expansion on unemployment insurance. There have been payments to low to moderate income individuals to help bridge them. There's been a small business loan program, the PPP, that I'm sure many of you are familiar with. And there's been specific funding to endangered industries like healthcare, like airlines. These are all good concepts. But one thing I'm focused on is that I think this downturn is likely to last longer than just a couple of months. So to the extent that these payments are a bridge to a post-COVID world, we also need to plan for what more is needed if the river is wider than we thought. The third piece is monetary, and given the Fed's independence, perhaps we could move the fastest. We took rates to zero at a special meeting in early March. We've given strong guidance to banks that they should continue to lend to good credits in need, and that we would adjust unnecessary regulatory constraints to try to support that. I might note this is not a simple task because we also are very focused on preserving the soundness of the banking system at the same time. The third thing we've done is significant interventions to try to backstop markets. We started by ensuring that Treasury and mortgage-backed security markets continue to function because they're really the basis for all lending that happens in this country. And then with the support of the Treasury Department, we launched facilities which support commercial paper and asset-backed securities and money market funds. The recent CARES Act legislation put over $400 billion behind us to backstop some lending programs. And we've announced programs for new and secondary market investment grade credits. We've announced a lending facility to take PPP paper effectively off of bank balance sheets and give them capacity to lend. We've announced a short-term municipal tax anticipation facility. And as recently as yesterday, we outlined more details around a Main Street lending facility, which would make 4-year loans with first-year payments deferred to medium-sized businesses. As Chair Powell said yesterday or Wednesday, these are lending, not spending facilities, focused on supporting good credits through their time of need. And so if that's what we're doing, let me turn perhaps to a few reflections going forward. In my mind, the core challenge here is getting to the other side of this with a healthy population and a functioning economy. And now, as states begin to emerge from this lockdown, that means we need to be working on the economy's recovery rate and its landing point. On the recovery rate, I do believe we'll be able to return to somewhat close to normal operations, albeit at a gradual pace. The experience of China and our essential industries gives me confidence this is doable, so long as we have widespread adoption of some proven protocols, like structural distancing, cleaning procedures, temperature testing, gloves, masks, and the like. The more challenging task I see is returning to consumer confidence and spending. This has been a real shock to consumers. If a treatment or vaccine appears, that would be great, but if not, infection risk will remain as consumers consider returning to the economy. And that means businesses that require personal interaction are going to need to rethink their protocols. They'll need a story that'll convince consumers it's okay to shop or travel or go to a restaurant again. I'm always reminded of the TSA post 9/11. It was messy for 3 months, but at the end of that, you did have some confidence that your security was stronger than it had been beforehand, and it was safe to fly. If you go to a supermarket today, you'll see similar moves. Someone with a mask will meet you at the entrance and wipe down your shopping cart. My supermarket has actually one-wayed the aisles. There is tape on the floors to make sure people keep social distance. The cashiers have sneeze guards. All those are the kinds of things that are going to need to happen to convince consumers it's okay to engage in commerce again. But I do want to caution it'll be slow going. According to ShopperTrack data, retail traffic in China and South Korea is still 40% down from last year. Somebody used the phrase yesterday that I kind of like, that we took the elevator down, but we're going to need to take the stairs back up. So I've talked about recovery rate. I also worry about our landing spot. In other words, how strong the economy will be at the end of this. You can think of the potential of our economy simply. It's the size of the workforce multiplied by the productivity of the workforce. And in the aftermath of this crisis, I think both factors face real threats. Our response to this crisis has closed schools and daycares, while also threatening traditional forms of elder care. Dual career couples and single parents or care providers face daunting challenges in balancing work and home responsibilities. Without more support, many risk leaving the workforce. Perhaps vulnerable populations, baby boomers like me, will protect their health by retreating from the labor force too. The great number of waiters and retail clerks dislocated by the pandemic may struggle to move into new careers. And some of our pandemic control efforts are making immigration even more difficult. In an environment where demographics were already shrinking our complement of prime-age workers, these changes could accelerate its decline. Productivity could be challenged too. A new set of health distancing protocols in restaurants, retail, and manufacturing operations will likely reduce throughput. Real estate assets are being stranded. Businesses are already redesigning their previously optimized supply chains, refocusing on resiliency, perhaps at the expense of efficiency. More fundamentally, increased debt loads, reduced bank lending capacity, and diminished confidence has to have a meaningful impact on investment levels, through which most productivity enhancement is funded. Now, there's still much we can do to avoid a smaller, lower productivity workforce. As states plan to restart the economy, I hope they can make our care industries a priority to support workforce participation. Job retraining needs to be a focus too. One bright spot of the current shutdown has been the investment made in online educational delivery. Perhaps states will find they can deploy online retraining to the broad swath of the unemployed, perhaps even at a very low cost. And finally, in the spirit of never wasting a crisis, we should be motivating business investment in new productivity levers. I'm reminded that airline kiosk adoption only really took place after 9/11. Perhaps retail self-checkout, food delivery, telehealth, and yes, online education will see similar adoption escalation, as will surely online shopping. Perhaps new productivity investments will need some government incentive to bring confidence back in an uncertain environment. To sum up, it's notoriously hard to be optimistic when you're in the depths of a crisis, as we very much are now. But I'm a big believer in American science and its ability to create a vaccine and a treatment in time. I'm also a big believer in the creative capacity of American workers and businesses. They need to reimagine their businesses to help consumers regain their confidence, while the rest of us do what we can to provide the health and fiscal and monetary support necessary to bridge there. Thanks, and I'm very much open to questions and comments.
Thank you very much, Tom. For those of you who are dialing in or who are on our chat, this is Ashley Duckman, the Vice President of Government Affairs for the Maryland Chamber of Commerce, and just wanted to echo my colleague Whitney's comments and thank you very much for your time and for being with us today. For our attendees, we are accepting questions through the chat feature of the GoToMeeting platform. If you need more specific instructions, there are icons toward the top of your screen with a little chat bubble where you can type those in. And while we wait for them to come in, I have just a few, if you don't mind. You spent some time talking about downturn and recovery, and depending on which economists you listen to, there are lots of predictions being made about what the shape of that curve, what the shape of recovery will be, and also sort of the timeline. Some saying 12 to 18 months, others saying 18 to 24, others saying longer. I wonder if you might elaborate on your thoughts at this stage as to what you think the shape of that curve might look like, and if there are any sort of bars around timing that you can predict at this stage.
I think it's very hard to predict timing unless you land a prediction on when people will feel comfortable being out of their house and with strangers. Or put differently, when will we have a treatment? When will we have a vaccine? When will we have immunity? And so I sort of see it in phases that are gated by that. I think we will see in the third quarter a meaningful uptick from the second quarter. It's hard to imagine we wouldn't, given how deep the second quarter is likely to be, and given that we're going to restart large parts of the economy in that time frame. So I think you'll see a big pickup there. And then I think the trajectory from there depends very much on consumer confidence in their health and therefore re-engagement. If you get to the fall and you imagine that we have a treatment that people have confidence in, and you see reports of people suggesting that's the case, then I'd assume we would move back at a reasonable pace, and that by the time we got to 2021, you'd feel like it was an economy you recognized again. If, on the other hand, you get to the back half of 2020 and you have a second wave of infections, or you just have continued fear about the implications of engaging with strangers in commerce, I think it's a much slower recovery. And I don't mean to be vague on it. I just think you have to accept that the uncertainty about healthcare swamps the uncertainty about recovery rate.
Thank you very much. So turning our attention to some of the questions that are coming in from our participants, we have one here that is a little bit of a two-parter, but it says, how long do you think that the major centers of the U.S. can remain shut down without permanently impacting our country's strength and place in the world? And then secondarily, is there unlimited ability for the Fed to spend to, quote, stabilize the U.S.?
Yeah, so on the first question, I guess I'd just make the point that the rest of the world is shut down too. So if we're worried about our stature versus the world, I saw Europe's GDP numbers. They're significantly worse than ours. China's already been through this, and they're on hopefully the other side of it for them. So I don't think this is an issue of relative economy. I think the entire world has unfortunately got the same problem, and this will hurt all of us. I do think that the U.S. and China are two countries that are the least exposed to global trade. If you're in a country like Germany or a country like South Korea, you've got a huge part of your economy exposed to trade. And so the weakness in the global economy is going to hurt many of those countries even more than it's going to hurt us. But, to, I guess, the other suggestion in your question, I don't think we can keep the U.S. shut down permanently without impacting the strength of our economy. So that is the very dicey situation where our leaders are working with now. Is there unlimited ability for the Fed to spend? I want to, I guess, make a point that the Fed doesn't do spending. That's really the role of Congress. And the legislature has done a lot of spending over the last few weeks. And, who knows what more is to come. What we do is we lend, we don't spend. And by legislation, we're not allowed to lose money on that spending, on that lending. And so, we can invest behind making markets function better. We can lend to good credits, with the support of this Treasury backstop I mentioned earlier. And our ability to do that lending is limited only by that backstop which Treasury provides. But we really aren't the folks who are spending. That's really the job of the legislature.
Thank you. Another question that we have sort of speaks to where you ended your opening remarks with respect to landing spot and the size and productivity of our workforce. And this participant asked, what are your predictions or thoughts on staffing re-engagement? How do businesses overcome this challenge that they're having with the fact that employees are sometimes able to make more money utilizing unemployment insurance benefits than they are coming back to work, and how might business overcome that?
Yeah, it very much depends on the business. It's really a stunning turn of events. If we were having this conversation just in early February, the number one message I got from every single employer was, I can't find workers. And, now we're going to have, perhaps mid-teens, high teens unemployment rate. So it's just a stunning. I have talked to a lot of employers who are concerned about the extra unemployment insurance, at least as I've probed how it is working right now. While you will hear stories of people quitting for higher unemployment, they're not doing that. I don't hear them doing that at scale. What you do hear is a bunch of people trying to hire folks. For example, someone who's just gotten a PPP loan and is trying to bring their workforce back, telling me it's awfully hard to rehire people because they or their families are saying, tell me again why I would go back to the workforce if I'm making more money on unemployment and I'm taking a health risk by going back. So that's where I hear it more on the rehire or the hire mode than on the depart mode. Remember that enhanced unemployment is time limited. And right now, there's not a massive number of people hiring. Otherwise, you wouldn't have these unemployment numbers. So I guess my hope is that will normalize in time.
Thank you very much. And I wonder if you might comment on and provide us with your thoughts on SBA's Paycheck Protection Program. Frequently in almost all of our webinars, it is the issue that receives among the most attention from our membership. And one of our participants asked if you could, in particular, comment on the number of small businesses that have received Paycheck Protection Program funding, and maybe if you have any thoughts on the estimated number that have not been funded or have applied, and just maybe more generally your thoughts on the challenges and implications that have unfurled as the program has come online and then been re-upped by Congress late last week.
Yeah, so this is a congressional program, the PPP, implemented by Treasury and the Small Business Administration. And so the Fed has not been in the middle of this program, other than we've created this facility for banks who feel like they've done too many of these loans to offload those loans to us. But as I talk to small businesses about the program, you obviously have a concept that isn't perfect for every small business, but is much appreciated, which is a forgivable loan if you maintain a certain amount of employment. There's been frustration I hear from businesses about banks supporting those applications. The banks, in some cases, are nervous about some of the restrictions on them. Think foreign ownership, think know your customer kind of constraints. There's been frustration about the funding that got overloaded in the first case and how much money is going to come out in the second place. You've seen some news reports about people who got money that I think the legislators wished hadn't. So you hear that. And all that is sort of part of what I'm sure has been part of your webinars every time. What I'm hearing more and more about now is, wow, this is 8-week funding. And even if I've gotten it, I don't know if my business is going to be vibrant enough, call it 6 weeks from now, to support the employees that I've brought back. And I think that's where people are worried, that the length of this downturn is going to be longer than the 8-week length of the PPP. And that all the frustrations aside, even those people who've gotten the money, as I talk to them now, are nervous about what the future looks like. Is it going to be extended legislatively? Is it going to be replaced by something else? What am I going to do at the end of it? So that's a place I'm focused on now, which is how wide is the valley, and is the bridge long enough to get us there?
Thank you. I sort of have a sector-specific question here, and an attendee wondering if you have an opinion regarding the near-term prospects for the oil and gas industry.
Yeah, I mentioned earlier that large parts of the oil and gas industry are really going to struggle at $20. Particularly the fracking, shale, that whole sector, which my understanding is only profitable at sort of $50 oil. There's been a lot written in the papers about the Saudis and the Russians, but I would just point out there's been a massive drop in demand, and that if you're on the roads today, you'll notice there are very few others out there with you. Obviously, large parts of the airline industry have shut down, and so I think there's just been a significant drop in. And until that demand comes back, I don't think we're going to much optimism in that sector. And so I don't think the near-term prospects look good at all.
A question here, thank you. A question here about interest rates and sort of your prediction for where interest rates are headed over the next 30, 60, 90 days and beyond.
Well, I can't exactly answer that question for all kinds of obvious reasons, but I might point to a statement that we gave, which is that, and that the chairman said in his press conference, but we've taken rates to basically zero. And the forward guidance we've given in our statement is, we're comfortable with that posture until such time as we're confident that we've weathered this crisis, and until such time as we see the economy headed back toward a 2%, our mandate, which is maximum employment and 2% inflation. And it sure feels to me like we're nowhere close to that.
Thank you. We have a question here about, from one of our participants, do you envision the United States going to a cashless economy? And if so, how might that affect the banking industry?
Well, I should start by giving the caveat that one of the jobs of the Fed is actually to process and put in to the economy the cash that's in there. So we do have an essential part of our business, which is the folks processing cash and making sure there's enough in ATMs or whatever to survive. It would probably surprise everybody on this call to know that cash in circulation has actually doubled over the last 10 years. I would have thought it was headed down when I joined the Fed, but it hasn't. It's actually been headed up. And some of that is domestic. A lot of that is international because of the strength of the US dollar and people who use it as a store of value. So I guess I don't see it. I don't see any trend that suggests it's going away, other than to say there are large parts of the economy right now that are cashless. I mean, I have $100 in my wallet, and it's probably the same $100 that I had, 3 or 4 weeks ago. And other than, giving a tip or giving a haircut, I'm not sure I'm using cash much. I think a lot of us are the same way. I don't think lack of cash would affect the country or the banking industry much. I will say there's a large part of the economy that is unbanked, and a lot of what they do is in cash. And so, I think for those of us who run businesses or the like, we don't think of it that way. But there's just a lot of cash used in places we don't commonly see it, and I don't think we're anywhere close to that at this point. Getting out of cash at this point.
Great, thank you for that answer. Just a question that I have while we wait for a few more to roll in. You spent some time talking about relief that had already been provided by Congress and from the federal government, and also touched on the fact that more would need to be done. And we've been seeing over the course of the last week more and more noise in the press with respect to what a fourth stimulus package, or COVID-4, however you want to characterize it, would look like. We're seeing sort of some of the tenets of that debate starting to tee up and play out. And so I'm wondering if you might comment on your perspectives on the fourth stimulus, on COVID-4, what critical components for new sort of programs, for lack of a better word, might be needed, or fixes to existing stimulus programs. What should Congress be most focused on as they start thinking through COVID-4?
Well, I think the Congress people are the professionals in terms of what specifically goes into legislation. I might just underline two themes that I've talked about in my talk. One of them is stabilization. And to the extent you think that the valley is wider than we thought it was originally, then there are individual small businesses who may well have additional need for stabilization. And so a great example of that would be hospitals. The hospitals are absolutely critical in this situation. By foregoing elective surgery to create beds available for COVID patients, the hospital system has taken a massive hit in terms of their cash flow. And we really can't afford not to have hospitals in this situation. So, what we need to do to support, our hospitals in this time is a classic sort of stabilization issue. And so that's one piece of it. But I think it's also going to be, we're moving toward the time where a second theme will also matter, which is revitalization. And how do we stimulate consumers to be spending in the right way? How do we stimulate businesses to be investing in the right way? And that would be another type of incentive, which can be done in multiple ways that I think are well worth thinking about. So I think there needs to be more on stabilization, but I think it's also timely to start thinking about revitalization.
Thank you. Another energy question, if you don't mind. With the recent U.S. energy independence coupled with low fuel costs, how does the Fed factor this in when looking at the 2% inflation benchmark?
Yeah, well, prices dropped quite significantly in the first quarter, and I certainly assume they'll do the same in the next couple quarters. A large part of that is demand dropping, but also, oil prices are a huge part of the prices felt by consumers and businesses. I think over the medium term, though, oil prices are very volatile. We've seen them in the last 10 years at $130, I think, a barrel. And of course, we've seen what we've seen in the last couple of weeks. So I look at the price index that includes oil and gas, but I also look at the core price index that excludes oil and gas as another metric. And I think that core pricing is much more driven by people's expectations on inflation than it is by the day-to-day movements of oil and gas. Or put differently, if you thought oil was going to stay at $20 a barrel and then next year go to 10 and then go to 2 and then go to 1, maybe you'd think that'd be deflationary. But I guess I think there's somewhere in the future we're going to have a significantly more expensive barrel of oil, and that would drive inflation. I try to look through that and focus on the core. And I think the core is driven by expectations. I noted that first quarter PCE inflation was in the 1.7, 1.8% range. Our target is 2. So not quite at our target, but certainly not in any disastrous place.
Thank you very much. We have a question here, again, on unemployment and notes that, as we all know, there are many businesses that are not likely to return to the same staffing levels as they were pre-virus, for a lot of reasons, but one being a modification of their business model. Do you have any projections or thoughts about where unemployment might be by, say, midsummer, July?
Well, as I said, we're pretty close to that number. We're pretty close to knowing that number now. I mentioned the 28 million people who filed for initial unemployment insurance. I talked about mid to high teens unemployment rate in the second quarter. And I talked about I don't really see our return to work or a return to commerce as being a rocket ship. I see it being much more gradual. And so if you look in June or July or August, it's hard for me to imagine that those mid to high teen unemployments will have dropped into the single digits. So I think you'll still see teens level of unemployments, which would be, historically quite high.
Thank you. Another question here, a little bit sector specific, but also has some broad application. Is the recent shifts to working from home or remote work likely to impact commercial real estate occupancy and values as a trend into the future? Is that something you're looking at?
Well, I'm always a little nervous about declaring the future. I think people said their bank branches would go away about 50 years ago. I had a question about cash earlier that also was about to go away. And so, the notion that people are just going to work from home is the kind of thing that's natural to talk about. But I kind of want to get a better feel for what normal looks like once we have figured out a treatment or a vaccine for this virus. I do believe that just like I mentioned, people got more comfortable with kiosks or online check-in for airlines after 9/11. There's a suite of people who got more comfortable with working from home. I can tell you the Fed was not a work-from-home environment when I arrived, and I had been a consultant in my prior life, and I was used to working on the road constantly. And I think our team has gotten much more comfortable now with remote working. So there will be some amount of that. But don't forget that also what happened in commercial real estate over the last 10 years was a significant densification of workplace environments. And if you believe that people are going to be more attuned to social distancing, structural distancing, there might be some changes in some of those bullpens in some of the places as well. So I'm not as nervous about the long term for commercial real estate. Now, retail real estate, I think there's more challenge there. For sure, this will accelerate the move to online retail. For sure, there are a lot of small businesses, retail businesses that are going to struggle to come back after this. And so, it wouldn't surprise me at all to see an overbuilt retail real estate sector coming out of this and seeing that footprint decline over time.
Thank you. I think the next question we have is particularly relevant, obviously based on where we situate in the country relative to the federal government. And this person asked, in prior recessions, public sector employment was relatively safe. What are your thoughts regarding public sector employment in the medium and long term?
Well, if you go back to 08 and 09, I do think the area around Washington, D.C., and certainly state and local public sector employment did hold up better in 09 and early 010 than lots of other sectors. But there was a austerity move in Washington, and there were constraints to state and local funding coming out of that. And so by the time we got to 2011 or so, in our district, we actually saw stronger growth in some of the non-governmental parts of our district than we did in the more governmental parts of our district. And that's, of course, a question on people's minds today. We've added to the national debt. And will there be a point in the future where the federal government decides to invest in austerity? I think that's a open question, but at some point, presumably yes. And one of the reasons why you see the back and forth over state and local funding is that this downturn is putting a lot of pressure on a lot of states and municipalities. When people don't have work, they make less money, they pay less taxes. When companies make less money, they pay less taxes. I live in Richmond. Richmond, a lot of stuff is funded through a restaurant tax. When the restaurants are closed, they don't have that. And so I think a lot of state and local public sector organizations are feeling the heat, and we'll see what, if anything, happens to help fill that funding gap.
Thank you very much. A question here from one of our participants. The Fed has made available a municipal liquidity facility. Do you think the state of Maryland or Baltimore City would be served well by taking advantage of this facility as they face constraints on their budgets?
Well, I want to come back to, and so first of all, both Baltimore and Maryland are eligible for this. Think of it as a tax anticipation loan. It's not grants. Again, the Federal Reserve doesn't have the authority to give grants. It's a loan, and it's a secured loan. And so to me, it comes down to, this isn't about a budget issue. This is about a liquidity issue. So if either Maryland or the city of Baltimore has liquidity issues, people are filing their taxes 3 or 4 months later. We know the money's coming, but it's just going to be a 3 or 4 month gap, or we have to do this investment, we're going to pay it back, then I think it's a very effective thing. If the issue is you've got a budget hole, this is not operating cash. This is financing. And so it doesn't feel to me like a budget issue. It feels like a financing lever.
Great, thank you. This is a question that was following up on some of your thoughts on Congress's move toward COVID-4 and what that should look like. And you mentioned that they should be thinking about revitalization programs that encourage consumers to start spending again. And one of our participants asked if you might elaborate on that and what you mean by revitalization programs that you'd like to see Congress considering in order to accomplish this.
Yeah, and you mentioned Congress. I feel this is purely a congressional thing. If you think about what are things that help motivate consumers to spend, I lived for many years in a state that had a back to school sales tax holiday, and it got a lot of people out of their houses to go spend on back to school stuff. That's one. It's a tax incentive. Another version of that would be, business investment incentives. And there are a lot of other ways you can think about doing it, depending on how you wanted people to engage in commerce. I read an editorial a month ago that I thought was really articulate. It said the single best stimulus we could give is help. And what they were saying was not, personal health care. They were saying testing and those sorts of things. And I might say, if I felt confident that if I did these three things, I could engage in commerce and not put my family at risk, that would be very powerful. And so whether it's the CDC or a state or national administration, folks standing up and giving people fact-based confidence in their ability to engage in commerce, that would actually be very stimulative in and of itself. And so again, here's a set of protocols that we have tested and believe strongly you can operate your factory if you just do these 5 things, whatever combination of temperature testing, masks, and whatever, that would be very stimulative. If you said, and if we knew that the risk of infection from somebody sitting at a neighboring table in a restaurant is basically zero, that the way you get this is by sustained, any insight you can give people that would allow them to be more confident on their engagement with commerce, that's the core of stimulus to me.
Thanks, Tom. That was sort of going to speak to my last question, which was going to be about consumer confidence, and you've outlined here what you think that the government can do to help assist in rebuilding consumer confidence through those public health and safety measures. But my last question was going to be, what advice would you have for businesses specifically on how to rebuild that consumer confidence? And it sounds like it would be much of the same, but didn't know if you had any additional thoughts specific to what businesses could do as we look toward rebuilding that consumer confidence.
Yeah, I come back to my supermarket. Of course, we need to get groceries, but why is it that we've gotten comfortable? We could get Instacart or somebody to deliver it. Why have we gotten comfortable going to the grocery store? And I really think there is, what I'm going to say isn't entirely fair, but when the TSA rolled out, some of us who traveled a lot of the time didn't know whether we were actually, everything we needed to do made us safer. It just made us feel safer. So standing in that long line in the TSA, having somebody inspect your toiletries, all of those were part of the show to say, we are taking care of you. And I think we were safer, but there was also a show that made people feel we were safer. And so I do think if I talked to a guy who runs a chain of pizza parlors today, and he was talking about how he's thinking about operating pizza parlors tomorrow. Now they're advantaged in a business because delivery and takeout is a much more prominent part of.
Oh, are you there, Tom? I think we may. I think you're cutting out a little bit. Can you?
Okay, sorry.
There you go.
Better now?
Yes.
Anyway, often, cane comes from off stage to make it clear you ought to leave, and maybe this is AT&T saying it's time. But all I'll say is there's a show that you can put in a business that makes your customers feel safer, and I really think there's real value to investing behind this, because I think people want to engage, they just want to feel safe.
Perfect. Well, thank you so much for your time, for your expertise. We very much appreciated a very well attended webinar. So that suggests that we have a lot of folks very interested in this topic. Have no more questions coming through. So with that, we will end today's webinar and just again say thank you to Tom and the Federal Reserve Bank of Richmond for your participation and partnership with the Maryland Chamber of Commerce.
Thanks so much and stay safe.
Thank you very much.